Well, we've got this man joining us, Chris Vecchio. Let me explain, and you're good for the market, Chris, because all four indices, even the S&Ps, NASDAQ, Russell, and Dow, just turned green for the first time when your lovely picture came up on the screen. How are you, Mr. Vecchio?
I'm doing very well. It's good to have the Bat Boys here together. Miss you, Tom, but this will be fun.
We hope so. We hope so. What are you going to bring us? What are you bringing with us? What are you bringing with you today for us?
Well, I figured we'd talk about Jackson Hole because we did have the Fed Chair Powell speech on Friday, of course, and he did have a really good line in there talking about how monetary policy is moving. We're navigating by the stars underneath cloudy skies. Has to have a philosophical turn, of course.
Beautiful. It's like a haiku.
It is, but I think the important thing there is that there's been this talk about the R star, which is the neutral rate of growth, the Goldilocks rate at which the economy doesn't grow or shrink, inflation doesn't go up or down, the unemployment rate stays even, more or less. And a lot of academics have been saying that the R star has moved up. You have to do more to raise rates. Powell doesn't mention the R star in his entire speech, and then he has this quippy line at the end about how we're trying to follow the R star, but we don't really know where it is right now. We're underneath the cloudy skies. And so I thought that was a brilliant turn of phrase. But perhaps more importantly, it's the market's reaction to Powell that we should be taking cues from. When we look to the ZQ futures curve or the SR3 contracts now, which are available on the tastytrade platform, we can see that the market is not dragging forward rate hike expectations for the month of September. And in fact, they've started to even out and back off a little bit for November. It's very possible that we've seen the last Fed rate hike. Now, granted, I don't think that we should discount the fact that there could be another one coming around the corner. But for all intents and purposes, it does not appear like September will be the meeting in which that occurs. So much of Jackson Hole was like attending a music festival this past week. Sure, you go out there for the main headliner, right? We're all there to hear Powell. But it was some of that side commentary, those secondary shows that proved to be more important or more interesting.
It was like
markets.
It was like Lala or something like that, or Burning Man, or what was it? I mean, is that what it was?
Exactly. You know, I remember going to Electric Zoo a number of years ago, and we went there to see David Guetta, but quite frankly, it was all the other musicians and people who were perhaps providing more of the entertainment over the course of the day. David Guetta was great at night, but during the day is when all the fun is had. And so to the point of what's happening in Jackson Hole, or what happened in Jackson Hole, it doesn't really matter if it was a non-FOMC voter or a FOMC voter, if it was the Cleveland Fed president or the San Fran Fed president. You hear all of these little remarks that basically give clues that, one, we know the Fed is a consensus institution, but secondly, the consensus is that they may not need to do more moving forward. It also means that we're not going to see rate cuts anytime soon unless something breaks dramatically. The market at least has understood that. The reaction that I think we've seen here the past few days substantiates the view that maybe not higher for longer, but we're going to stay high for a longer period of time. Why does this matter for traders? Because I think about that steepening trade, Tony, that you and me and Tom have been talking about for many months now. It would appear that it becomes a little bit more difficult, in my opinion, to justify holding on to a steepener in the very near term, because we really shouldn't see much change in terms of how these treasury bonds are trading relative to where they are right now. And I say that because the historical tendency is for the bond market to bottom at the meeting prior to the final rate hike. And we just don't know when that is going to be. Could that be November? Possibly. Have we already seen that in hindsight? Perhaps. For me, it means that we're going to just see a lot of capital tied up in a trade that may not go anywhere anytime soon. I think there are more appealing opportunities in equity markets, particularly the index futures right now, which are carving out decent ranges and are offering fairly interesting clues for the next directional move, fairly defined levels of risk to work around. And so Jackson Hole, it is now in the past, but this is an event that I think will probably not be remembered. As we discussed on last week's Let Me Explain, Tony, was it the most important event of the week? Absolutely not. It was NVIDIA earnings that proved to be the bellwether for markets.
Yeah. And not to change gears, but you just mentioned NVIDIA. NVIDIA's up $4 and change, back to 72. It's the mid-range for its whole move that it had for earnings. But getting back to reports, is there a JOLTS report out today too? Is there?
There is a JOLTS report out today, Tony. You're very good, keeping an eye on the macro calendar. And JOLTS is one of those reports that people really didn't care about until, we'll say, the past year, right? These are the job openings throughout the economy. Now, typically, if you go back to pre-pandemic time, you're looking at the economy being at full capacity for employment when there are roughly, we'll call it 6 or 7 million job openings in the economy. Post-pandemic and up until a few months ago, we're talking about there being 10 million, 11 million plus job openings. When you look at the non-farm payrolls data, that means there are effectively 2 job openings for every single one unemployed person in the country. That's a lot of slack in the labor market. Why do we care about JOLTS? Because if the labor market is tightening as the Fed believes it should, that we should be seeing the unemployment rate ultimately go up, first the job listings have to come down. Those JOLTS are due out at 10 o'clock Eastern this morning, so in about 12 minutes time. That could be one of those important catalysts this week, kind of how it was in the beginning of July when we had the July 4th holiday. You have the JOLTS, we have some of the housing data. All of a sudden the market gets skittish going into non-farm payrolls, which I was wrong. I thought non-farm payrolls was next week. Apparently it's this Friday, so much so that I think that we actually have one piece of macro event risk we should be worried about. But do we really care right now? I mean, we're really at the point where you look at the options market here, no one is pricing in any sort of significant move. If it's in bonds, if it's in equities, we're basically going to see the data, mark it off, and then go back to our Labor Day vacation. Macro data is taking a back seat right now. The path forward by the Fed seems preordained, and there's nothing that can shake us off that.
Mm-hmm. Well, you've got bonds trading at 120. Let's just call it on the nose. They're actually 120.07. They just caught a little bit of a rally because they were under 120 a moment ago. Volatility in bonds has been upticking steadily for the last 3 or 4 days as they've gone, basically nowhere. IV rank is 19. Sounds like a low number, but when you have every equity, even in NVIDIA, with single-digit, IV rank, bonds all of a sudden become an interesting play. Now, I'm the world's worst bond trader. I've admitted that on my podcast. I've admitted it here on the show. When I was at the Board of Trade and I was trading bonds in the bond pit, they all told me I was the worst bond trader in the entire world. So it's confirmed everywhere. So for me, when people start talking about bonds, especially Tom and now you on direction on bonds, man, I don't see how you can figure out bonds at all. For me, it's the hardest thing in the entire world. And this inversion that you now said, I'm going to play the role of Tom for a minute, that maybe there's better places to go. Tom would argue with you that it's probably the best place to go because the street is finally thinking, or the public is finally thinking, Chris is finally thinking that there is no more opportunity there. When you least expect it, that's when he would say that we're going back to a regular, curve as opposed to being inverted the way we are right now.
Yeah. Timing is a question of this, right? Because not everyone has unlimited capital. And certainly I think that's one of the considerations in my head. Do I want to tie up something into a trade that could take 6 months to play out? And quite frankly, the answer is no. I'd rather use my capital and looking at shorter term cycles and putting something on for 2 or 3 weeks and taking it off and reallocating the capital than just having to constantly roll forward a position that may just eat away for the next 3 to 6 months. I will say in terms of directional bet on bonds, I don't think the directional bet is here per se right now. I mean, I think about ZB, it's traded below its 1 month moving average every session since July 20th. So to say that this is the absolute low, we don't know that to be the case yet. There's no sign of momentum having been broken to the downside. That said, if you look to the options market and you think about where we carved out the lows last year, 114, 116 put spread in ZB, for example, right now, it's offering you 80% chance plus of pop, right? Probability of profit, excuse me. Yeah. And so the point is here that at least the options market is saying, if we think that we're going to go higher in terms of yields, lower in terms of prices over the next few weeks, there really isn't that priced in the cards right now. So if I am playing this directionally, I think the put spread remains appealing. You note that bond volatility has ticked up, at least it's on a relative basis higher than its equity market counterparts. I would point to the MOVE index right now, which is actually seeing volatility fall across the board. This is the ICE B of AML US bond market option volatility estimate index. That's a mouthful. But bond vol is holding near some of the lowest levels that we've seen over the past few months. really prior to the start of the SVB Signature Bank collapse that led into the regional banking crisis and then the U.S. debt ceiling debate and ultimately debacle. So bond vol to me, it's not really that high, just relative to its equity market counterparts. It's a little bit more elevated when you look at the IVRs.
What do you think? So I know you've been kind of leaning bullish over the last couple months. I've been in that same sort of camp. Does the idea that the rate cycle is stopping and that the uncertainty is kind of getting less uncertain in the space, does that spook you a little bit? Like, does that make you, I mean, are you still as bullish as you were prior to, I mean, does that change your perspective on markets?
Not in the very short term, because right now the United States economy is just growing so darn fast, 5.9% according to the Atlanta Fed GDP Now growth tracker for the third quarter. Granted, it's still early. There's a lot of data to be seen and heard. You really shouldn't take that estimate too seriously until you get into late September. Really, if you want to be frank about it, early to mid-October. But the fact is, the unemployment rate is sitting near cycle lows. Inflation has come down substantially. Growth is moving up. Sure, that means that the Fed could probably sustain higher rates for longer. The bigger risk for the economy is what happens abroad. Eurozone sliding towards a recession. China slowing down dramatically. And quite frankly, even though we've seen Chinese equities rally here the past 2 days, I don't necessarily think the broader market is giving us a sign that we feel like we're out of the woods with respect to the property debt bubble situation that seemingly is unfolding over there across the Pacific. I also think about the seasonal tendency of these markets. I know that's kind of like astrology for men, as people say, or that's technical analysis, what have you. But the fact of the matter is that the statistical tendencies of these markets has been fairly reliable. When you think back the past 5, 10, 20, or even 50 years when it goes to the S&P 500, we happen to be in the window of the year, August, September, October, where markets tend to move sideways. When we think about how markets have performed, what happens in the early part of the second half of the year, once you see at least a 10% gain in the S&P 500 for the first 6 months, you see about 3 months of consolidation thereafter. And then to add another layer to that, the year before presidential elections, what happens in August, September, October? You see sideways movement in equity markets. So we're in that window where after such a strong rally that defined the first half of 2023, we should be, at least by historical standards, looking for a period of calming down. A correction in markets doesn't need to be just by price. It can also be done by time. The rate of ascent slows, and that may be what we're going through here. So when I think about the S&P 500 right now, we have a recent low near 4350. We have a recent swing high up near 4485. Both of those are fairly important levels because if you think about this from a technical basis, 4350 comes right around that area where you have the former early June swing highs. The 4485 is in that key zone 4480 to 4500 where you have a turning point that occurred throughout July and then was initially support through the early days of August. There is a little bit of a range that's been formed here, and you might say that's a right shoulder forming in a broader head and shoulders pattern, which would signal lower prices in the S&P longer term. For now, you treat it as a consolidation or a continuation effort sideways until you get a neckline break, of course. But a triangle, a consolidation, can mean a move in either direction. I think we're going into a sine wave type of trading environment where we'll see some losses. The bulk of the correction is now behind us. We may see some more gains, but China, Europe can be a little bit of a drag on price action. And so we don't really go anywhere quickly. For me, the range trading this week into next week seems to make a lot of sense with the way the options market is priced. And more importantly, with Labor Day around the corner, a lack of significant macro catalysts and earnings results due up around the corner, seeing significant directional moves here and now, it just doesn't fit with the way that I see things playing out. But yes, as it were, I do think that we're going to see all-time highs later this year. It's just going to take a little while for the market to digest this bulk of gains that we've seen here in the first half of 2023.
And volatility making new lows at 1615, at least for today, supports everything you said for the market keeping its wings up. 4350 is also the area where Mike, our two-time quarter
SPX
champion
guest, right?
in SPX, thinks the market's going to be in a month. So you've got a lot going in your camp with some of your numbers and some of the direction there. Good job out of you. You talked about interest rates. I read an article earlier today about how housing prices have rose in June in all of the U.S. top 20 cities, led by Chicago's rally. I know my son is looking at housing in Chicago. Prices are just outrageous. It doesn't seem like interest rates. The shortage of housing. The shortage of housing because of maybe some of the lower interest rates that people had locked in earlier, maybe fueling some of the housing prices and the squeeze that we've got here. Does that get tapered by this 7.5% monthly, or it's at 7.5% interest rate for houses, for loans?
It should for new home buyers. One of the things that drives me nuts about the conversation around the housing market right now are these comparisons to the late 70s or even 2007, 2008.
When I was paying 16% interest, you mean? Yeah, sure.
Yeah.
Compare it to me.
There's a few structural differences in the housing market right now at this point in place in time versus where we've been in previous decades. First off, housing supply is a significant issue. If you go back to the 1950s, in every decade, the 1950s, 60s, 70s, 80s, 90s, 2000s, the country builds about 25 million new units per decade. After the global financial crisis, we've been on a run rate of about 5 million new units per decade. So supply has come down significantly. That's one facet that why we see housing prices staying elevated. There's just not enough housing out there, period, end of story. The other part of this is the structure of the mortgage market's changed. 2007, 2008 crisis, about 40 to 45%, depending upon the estimates you look at, of homeowners had floating rate mortgages, and only 30% of homeowners actually own their homes outright without any debt, so to speak.
Whose fault is that?
Well, we can blame the banks. We can blame the government for putting the regulations in place. It doesn't really matter.
Or when you're pointing a finger, you got 3 or 4 fingers pointing back at you. You can blame yourself too, right?
There's also that. But where are we right now? Instead of 30% of people owning their homes outright, it's now about 40%. In terms of floating rate mortgages, it's down from about 40% to around 5%. Yeah. So when mortgage rates spike right now, if you own your home, it doesn't really impact you. It doesn't matter to you. It matters to new buyers. So housing affordability for new buyers are down, but the idea that people are going to see a significant dent to their balance sheets, at least for the average American, that's not true this cycle. And so that means you basically have golden handcuffs. You have a 3% mortgage like Dr. Jim Schultz, you're not moving anytime soon. There's no reason to. You're not going to go out there and get a 7% mortgage.
Well, nobody wants Dr. Jim to live next to him, so nobody wants him to move anyway. So you're fine there.
That's a different story. But the point is that there are these golden handcuffs out there, right? Yeah. You're not going to give up that very low mortgage rate, and thus you're not going to move. And housing supply is limited already because we just haven't built enough darn housing in this country over the past 15 years or so. And so this market is going to see higher sustained prices. There's not going to be a big deflationary period, in my opinion. It's going to take something really significant like a global recession. And even then, the floor has been raised. I think house prices are rather sticky at these levels.
Schultz number just came out. Bonds rallied about 8 handles, maybe a little bit more than that, maybe 12 handles. They're up 19 right now. Even the S&Ps are up 17.
High of the day.
What's that?
High of the day for
High of the day. High of the day for the S&Ps. High of the day for the NASDAQ, too, although the NASDAQ's only up 90 and change. It is the leader in the clubhouse. Good job, Mr. Vecchio. So far, so good. Do we fade this first move or we stick with it?
I haven't seen the JOLTS numbers, so I couldn't tell you. But if bonds you said bond yields are up or down after the data?
Bonds are up. Yields are down. It was weaker than expected. Your JOLTS number.
It just fits with the idea that we're probably not going to see the lows of last year plumbed in ZB. At least we're not going to trade through them significantly. The 114, 116 put spread to me still looks appealing. The idea that we've reached the peak or we're near the peak of interest rates comports with the idea that we're heading towards disinflation globally. China is a huge part of this story, guys. I know that we had these measures announced to make stock trading a little bit easier and friendly. Our brokerages in Hong Kong were effectively limit up yesterday. If you take a look at how that performed following the announcement out of the Chinese government regarding the tariffs, if you will, the tax on trading. Yeah. But when you look to copper, when you look to the Australian dollar, when you look to crude oil, the growth sensitive proxies in the market, they're not really doing well coming out of the announcement. We may have put a stem on the bleeding of Chinese equities, but in terms of Chinese growth prospects being resuscitated, I'm not there on that camp. That doesn't make sense to me. So this will continue to be a slow bubble that comes undone. The Chinese government, of course, is going to throw good money after bad. They're not going to let their economy collapse, but it means that they're putting their money towards unproductive uses, and that's servicing debt. That's not building new things. That's not helping people get jobs. And so slower Chinese growth means deflation for the global economy. That probably means U.S. Treasury yields are going to have a weight against them. It can keep the bond market afloat, if you will.
Very good, sir. Good stuff out of you. We'll take a quick 90-second break. We'll come back. We got more Tasty Live with a market measure next. Thanks, my friend. Appreciate it.